Many people would like to invest in precious metals like gold and silver, but they wonder which would be a better investment. They want the maximum return on their investment. While no one can tell what the future will bring, history does teach us some lessons. And one lesson regarding which precious metal to buy is the rule of 80. The rule says that the historic or proper ratio of the price of gold to the price of silver should be around 80. When that ratio is higher, silver is undervalued with respect to gold, and you should buy silver. When that ratio is less than 80, you should buy gold because then gold is undervalued with respect to silver. Is this rule still valuable in today's economic climate? Who knows, but many people still use this rule as their guide. Today, the ratio of the price of gold to the price of silver hovers right around 100. That is, 1 ounce of gold is nearly 100 times more costly than an ounce of silver. And according to the rule of 80, you should buy silver rather than gold. But how reliable is the rule of 80 today? Take a look at the short video to give you an overview of this guideline. When it comes to investing in precious metals, gold and silver are two of the most popular choices among investors. Both metals have been used as a store of value for centuries and are seen as a safe haven during times of economic uncertainty. The rule of 80 is a historical guideline that suggests the price ratio of gold to silver should be around 80. This rule dates back centuries and has been used as a strategy to determine the relative value between the two precious metals. However, in modern times, with the ever-changing market dynamics and global economic factors at play, the relevance of the rule of 80 is often called into question. Historically, the ratio of the price of gold to silver has typically been around 15 to 1 to 16 to 1, meaning that it would take approximately 15 to 16 ounces of silver to purchase 1 ounce of gold. This ratio was established by the U.S. government back in the late 18th century when it defined the dollar in terms of both gold and silver. One of the primary factors influencing the ratio is market demand. During times of uncertainty or economic instability, investors tend to flock to gold as a safe haven asset, causing the price of gold to increase relative to silver and thereby widening the ratio. Geopolitical events and economic conditions have also played a significant role in the fluctuation of the ratio. For example, during the gold rush in the mid-19th century, the ratio spiked to as high as 30 to 1 as gold became highly sought after. Similarly, in times of economic crisis or inflation, the ratio tends to widen as investors turn to gold as a hedge against inflation. In April 2025, the ratio stood at 100 to 1, indicating that gold was trading at a significantly higher price than silver. This widening of the ratio can be attributed to a number of factors, including the rise of gold as a popular investment asset, the decline in industrial demand for silver, and the overall volatility in the commodities market. Inflation and fluctuations in currency values have a significant impact on the prices of gold and silver. As safe haven assets, both gold and silver often see increases in demand during times of economic uncertainty, leading to higher prices. Despite its historical significance, the rule of 80 is not a foolproof investment strategy. The ratio can fluctuate widely and may not always be indicative of future market trends. Additionally, other factors such as economic conditions, interest rates, and global events can impact the prices of gold and silver. Ultimately, investors should be cautious when using historical rules and guidelines to make investment decisions, as the market is constantly evolving and subject to various influences. It is important to conduct thorough research, seek advice from financial experts, and take into account all relevant factors before making investment decisions in the precious metals market. The historical ratio of prices of gold to silver has been a subject of interest for investors and historians alike throughout history. But, as you must realize, the exact ratio has changed over time. Gold is typically more expensive per ounce than silver, which means that it may require a larger initial investment to purchase. However, some investors view gold as a more stable and reliable investment due to its higher value. On the other hand, silver prices have historically been more volatile than gold, with its price fluctuating more frequently. This can make silver a riskier investment but it also has the potential for higher returns in a shorter period of time. Both metals have traditionally been used as a way to protect against the erosion of purchasing power caused by inflation. However, some experts believe that gold may be a more effective inflation hedge due to its higher value and perceived stability. Ultimately, both gold and silver have their own unique advantages and disadvantages as investments. It is important to carefully consider your own financial situation and investment objectives before deciding which metal to buy. Now, if you are just getting started in buying precious metals, I'd like to recommend the online dealer I use. You'll find a link in the description. I think you'll find them a reliable source of precious metals with very competitive prices. In conclusion, it is important to conduct thorough research, seek advice from financial experts, and take into account all relevant factors before making investment decisions in the precious metals market. As with any investment, start small and build your confidence as you go along.
Thank you for taking the time to watch our video. We truly appreciate your support and interest in our content. We hope you learned something valuable from this video. If so, please click the thumbs up, like button to let us know. Now, we recommend you watch this video next. It will further boost your knowledge and skills in this important area.